Welcome to this expert level session on fees and investor accounting. In this video, we'll go beyond definitions and focus on how fees actually work in practice, how they affect investor returns, and how they are treated from an accounting perspective in private equity and hedge funds. Hi, I'm Dr. Tishta Bachoo, and today we are going to look at fees and investor accounting. Why fees matter? Fees are not just an administrative detail, they are one of the most powerful drivers of investor outcomes. They directly reduce investor returns and can significantly shift value from investors to fund managers. Here, fund managers will be used interchangeably with general partners. So this reduction on investor returns, which I mentioned, can significantly shift value from investors to fund managers, materially impact IRR. So you can imagine even a 1% difference in fees can translate into millions over a fund's life, which is why fees are one of the most negotiated and scrutinized elements of any fund structure. Moving on, the types of fees we have in the funds. Funds typically charge two broad categories of fees. The first one being management fees, which compensate the manager or the GP for operating the fund, and the performance fees as a second one, which is also called incentive fees. Okay. Performance fees, also called incentives, it depends on how you want to term it, and those details will be found in an LPA or an issuing document depending on the fund type. So these are the two main types of fees that you will come across in fund structure. Okay, and I was saying incentive or performance fees, they are meant to reward the manager for generating returns above an agreed threshold. So remember, management fees, it compensates directly the manager or the GP for managing the fund, for operating the fund, while performance fees, they are to reward the manager for generating returns above an agreed threshold. However, you need to note that mechanisms like hurdle rate or the preferred return, high watermarks, equalization, and side pockets, these are also fees, but they are used to ensure fairness, and this is where the complexity arises. So unlike management fees and performance fees, these four fees, they are actually meant to ensure that everyone a fund, whether it is LPs, GPs, and so on, they are fairly treated. This is to ensure fairness. We are going to have a look at how these fees are based, calculated, and how they ensure fairness as well. Okay, moving on. So the first one we are going to look at is management fees. Management fees, now what are they? As I said, they compensate the fund manager for running the fund. As you can imagine, in a fund there are so many work to do, taking care of board meetings, managing the fund, approving investments, and so on. So there's lots of nitty-gritty to be done. And of course, management do not do it for free. So in a way, when the general partner, when they are taking care of the fund, they need to be compensated. So they get in return what we call as management fees. Okay. These are charged regardless of whether the fund performs well or poorly. So even if the fund is not performing well, the general partner needs to get the compensation. They need to get the management fees. Okay. Now, this makes them a little bit predictable, but also controversial from an investor's perspective, because as you can imagine, if the fund is not doing well, why should the general partner be remunerated for what sort of job? So this is kind of something that is a little bit controversial, but irrespective, as per the legal document, whether or not the fund is performing, the GP needs to get the management fees. So next one, we are going to look at the management fee base. Now, you need to understand one thing. Early in the fund's life, management fees are typically charged on committed capital. So basically, if we have 15 investors, all of them have committed to a total of 100 million euros. So the management fees will have to be calculated on the committed capital, how much they have committed to contribute to the fund, irrespective of whether they have fully, whether the money has been fully deployed or not. We need to calculate the management fees on the committed capital. Okay. Now, how do we know the percentage? The percentage will be found in the LPA or the issuing document, depending on the type of fund, but there will be a clause in the legal document of the fund where the percentage will be found, and also how we calculate the management fees. Is it on committed capital of the investment period? Are we going to calculate it on invested capital or NAV, whichever is lower? So there will be like a paragraph written on management fees solely. But usually the way it works, when the fund is at a very early stage of its life, the management fees are typically charged on committed capital. So there will be a percentage of committed capital. Okay, maybe 1%, 2% of committed capital. After the investment period, maybe let's say after 4 to 6 years, when the investment period have elapsed, fees usually step down and are calculated on invested capital or the net asset value. At times it is whichever is lower. If the invested capital is lower, we take a percentage of that. If the NAV in a quarter is lower, we'll take a percentage of the NAV. Okay. Now, failure to step down the fees after the investment period is a common investor concern. Traditionally, now you would note that private equity funds, they charge around 2%. Okay, if I may write it. So private equity, it's around 2% of the committed capital. Sorry. So private equity, it's normally 2% of committed capital. We have hedge funds. Hedge funds, usually they are around 1 to 2% of committed capital. Okay. Now, these will change. It depends on the type of fund, and it also depends on the type of asset manager. But the actual fee depends really on the fund size, the strategy of the fund, and the negotiating power of investors. Because on these fees, you will see when you're launching a new fund and you're still at the step where you are reviewing the legal documents of the fund, the prospectus, the LPA, there will always be going back and forth with the investors concerning these rates. Now, management fees from an accounting perspective, we're already on this slide. So from an accounting perspective now, management fees are accrued over time and recorded as an expense of the fund. They reduce the net asset value and therefore investor capital accounts, okay, even before any investment performance is realized. So even if we do not have any investment, we will still record or accrue management fees in our expense, and this is going to reduce the NAV. Okay, the fees rate and the explanation of the management fees I have already mentioned. They are found in the fund's legal document, which is an LPA for partnerships, or an issuing document or funds prospectus for SICAVs in Luxembourg. Again, all the examples that I'm taking here is related to Luxembourgish funds. Now, you will note that when we are talking about fees, there are two levels of fees or expenses when we are talking about fund fees. Okay, one is really at the fund level, which, as I mentioned earlier, it will reduce the net asset value, while the other level of fees or expenses are at investor level. The investor level fees, they would reduce typically the capital accounts and the net returns. The two of them are very different. One is at fund level, which reduces NAV, and the other one is at investor level, which reduces the individual capital accounts of each investor. As a strong accountant, as a fund accountant, you need to always be able to reconcile these two perspectives. You need to be able to know which one is a fund level expense, which one is an investment level or investor level expense. Okay, now moving on, performance or incentive fees. These, as I said, they are the same. They are just used interchangeably. Performance fees, also known as incentive fees. At times, you can also see in some LPAs, they are referred to as carried interest fees. They are basically the reward the manager gets for generating profits, the fund's profits. Unlike management fees, they are not guaranteed and only arise if specific performance conditions are met. Right? Now, when do these fees apply? Performance fees are only earned after investors receive their capital back, and in many structures after they receive a preferred return. Again, these terms will be described in details in your LPA, but it is worth noting that I do have a video which I've uploaded. It is called Distribution Waterfall. In that video, I explain how and when capital is paid back to investors and how and when preferred return, if applicable, is given to investors. So if you are new to these terms, please, I would request you have a watch at the previous video. Then you would be able to understand why we return the capital to investors, and after that we pay a preferred return to the investors as well. But here, all you have to understand is the performance fees are only paid out after investors receive their capital and their preferred return. Okay, the sequence is very important. It is critical and it is enforced through waterfall models. You need to follow that. You cannot pay whenever you want, whatever you want. You cannot first pay a preferred return, then return the capital. No, there is a sequence to it. It has to be followed. In the previous video, I have also explained why. Okay. Now, hurdle rate or preferred return rate, it represents the minimum return investors must earn before the manager or the general partner participates in profit. Preferred return, we usually would pay this out before the GP gets an amount of the profit. Okay. Again, this part I have already explained it in details in the previous video called waterfall distribution waterfall. So hurdle rate, it usually would act like an implied interest rate on investor capital and protects investors from paying performance fees on modest return. The next one we would look at is catch-up mechanism. Again, this is a continuation from my previous video. Now, what is a catch-up mechanism? Many funds include a catch-up mechanism. Once the hurdle is met, the manager may receive a disproportionate share of profits until the agreed carry split. It can be a split or a ratio of 80-20, 85-15, 90-10. All these is achieved overall. But first, it needs the hurdle, or let's say the preferred return, needs to be paid out. Only then the manager may receive the share of profits until the agreed split. If in your LPA, let's say the catch-up rate is 20%, then the maximum that we will be able to catch up here is 20% of the share of profits. Okay. Next slide, we would look at high water mark. So for those who do not know what this is, a high water mark ensures that managers do not earn performance fees twice on the gains. Remember at the beginning I said these fees, they actually ensure fairness. So high watermark is one of those which ensures that the general partner do not earn performance fees twice on the same gains. If a fund experiences losses, those losses must be recovered before new performance fees can be charged. So we cannot double charge. And if we have a loss, the losses must be first recovered before the fees can be charged. We cannot charge it otherwise. Okay. Now, this is a high watermark example. You would note that even if the fund performs well after a loss, okay, let's say the NAV rises to 120, of course we will pay a fee on that, we will charge a fee on that. Now let's say from 120 the NAV falls to 90, which is a loss, okay, a loss of let's say 30. There will be no fees. No fees. Now, from 90 and now the NAV has gone up again to 115, still no fees. Why? Because it's only after a big loss that the NAV is back to increased. No performance fees is earned until the NAV exceeds the previous high water mark, which means we can earn a fee if the NAV goes beyond 120 again. Okay, even if it goes to 119, we would not charge any fee. Okay, we will wait for it to exceed 120. Only then we are going to calculate the high water mark and we are going to charge the excess. Now, why do we have this? Just to protect investors from paying fees on recovery. Next one, we are going to look at equalization and why it exists. Now, equalization, for those who already know, when there are new investors coming in, bringing new capital, committing to new capital, what we do for the investors who have already invested, like previous investors or existing investors, we will have to equalize their commitment. So basically, if they have already committed, we are going to spread it out and basically just take the new commitment and spread it out across with all the other existing investors. And the existing investors usually would get a refund on their the fees charged to them, because now the new investors will have to actually pay a portion of those fees. So this is basically what equalization means, where we are adjusting for new investors entering the fund at a different timing. Maybe closing was at the beginning of January, but then new investors came in August. So from January to August, whatever the existing investors have incurred, this needs to be spread out across with the new investors, so they are not at any detriment. Okay, without equalization, new investors could benefit unfairly from gains generated before they invested. That's why equalization is important. Okay, so existing investors do not overpay. Okay, now the equalization methods that we use, the first one is equalization credits. Then we have series accounting to ensure each investor pays fees only on performance attributable to their invested period. Okay, the next point is crystallization. It refers to the point at which performance fees are locked in and become payable to the manager. Okay, so basically, as the word suggests, we are only crystallizing it. At this point, the fee is recognized as a liability and reduces investor capital accounts. Hedge funds, unlike private equity funds, operate on a NAV-based performance with frequent crystallization and high watermark mechanism. So high watermark mechanism and crystallizations are very frequent in hedge funds, okay, unlike in the private equity funds. Moving on, we come to side pockets. Side pockets are used for assets that are illiquid or difficult to value, so where the valuation is not something that we really look into. It is sort of complex to value the asset, so then we have side pockets. They are accounted for separately to avoid distorting the fund's NAV. So these are not in the existing NAV. They are accounted for separately, and they often have distinct performance fee calculations. So again, if you have any side pockets in your fund, this needs to be clearly explained in the LPA or the prospectus. Accounting for side pockets. Side pockets significantly increase accounting complexity. They require separate valuation, okay? Separate valuation, separate fee accruals, and they also need transparent disclosure to investors. Okay, that's why we do it separately. We do not embed it in the NAV pack. If we have any side pockets, they are separate NAV tracking. We track them separately. We accrue for the fee separately, and we need to have a proper disclosure to investors on a monthly or quarterly basis, based on when we are doing the the investor reporting. Okay. Now, key takeaways. I would say understanding fund fees is essential, not just for investors, but also for analysts, accountants, and fund controllers. It's not only the percentage that matters, it's also the structure, the timing, and the accounting treatment. Okay. If you have any, I know I have been through more details for the management fees, but I don't want to have a long video here. So I will touch base on side pockets, crystallization, equalization, on more detailed video after this one, because I need to tackle one topic at a time, otherwise it becomes a really long video, and it's a nightmare to really upload it on YouTube. Okay, so I will finish this one here. So yeah, I mean, if there's anything that you will want me to touch base on with more details, please drop me a comment on this video, or just have an quick email sent to me, or even on my LinkedIn, whatever suits you best. Okay, so thank you for watching.